Okay, this is the second part of chapter 6. I'd like to say that there was a really good reason for me to breaking this up, but it really came down to the fact that my wife came home and I had to help with the groceries. And I didn't want to restart the video since I'd already finished the first part. Learning objective 4 is to prepare a segmented income statement that differentiates traceable fixed costs from common fixed costs and use it to make decisions. Again, managerial accounting. We're developing information so that we can use it to make informed decisions. A segment is any part or activity of an organization about which a manager seeks cost, revenue, or profit data. It could be a division, it could be part of a division, it could be a location. You can see here an individual store, a sales territory, a service center. There are two keys to building segmented income statements. A contribution format should be used because it separates fixed from variable costs, and we're able to look at the contribution margin. And we need to look at traceable fixed costs. So fixed costs that we know apply to that particular segment. Traceable fixed cost arise because of the existence of a particular segment and would disappear over time if the segment itself disappeared. So that we want to really be able to isolate those costs because we want to know that, hey, if we did get rid of this division for whatever reason, what cost would disappear? For instance, here you see the salary of a Fritos product manager at PepsiCo is traceable to Fritos. The maintenance cost for a building in which 747s are assembled is traceable to the 747 business. Common fixed costs just arise because the overall operation of the company and would not disappear. So if you had an HR department, you would probably have some traceable fixed costs. In other words, how many of these people are dedicated strictly to this segment of our business? But that would really be traceable fixed costs. Others, if you had the vice president of HR, you would still have a vice president of HR most likely, and their costs would still be with the business, the main business, if you got rid of part of this. So we want to make, again, informed decisions. So the salary of the CEO of General Motors, the cost of heating a Safeway or Kroger. Um, so it's important to realize that traceable fixed costs of one segment may be common fixed cost of another segment. Here it shows that the landing fee paid to land an airplane on an air at an airport is traceable to that particular flight, but it's really not separable into first class, business class, etc. passengers. So if you were trying to determine, what your profit is on these different passengers, you would just kind of allocate that as an overhead, but it's not a traceable to that particular business class. The segment margin is computed the same way. Okay. And it's the best gauge of the long run profitability of a segment. So we have traceable and we have fixed costs. Don't allocate common costs to these segments, which we will, and we'll show this, why you don't want to do that. Weber has two divisions, computer division and television division, and we'll look closer at these. So this is the television division, and you can see that the margin for the division is $60,000. We've got $300,000 of sales, variable cost of goods, and other variable expenses of 150. So that gives us a contribution margin of 150,000 or 50%. We have traceable fixed expenses of 90. So our division margin is $60,000. So that's contributing to the rest of the company. So here we have the television division, and the margin is $60,000, and the computer division is $40,000. So we have a division margin of $100,000, and then we have some overhead expenses that are really common and can't be separated or traceable to any one of these different divisions. So they shouldn't really be allocated to the division. What you really should look at is, do we have enough business to support our overhead? Do we have too much overhead at the corporate level that we need to get rid of? Fixed expenses that are traceable to one segment can become common to another. Okay. So let's now separate the TV division into regular and big screen. And you can see here that the margin on the regular is 60,000, and margin on the big screen is 10,000. But then we have common expenses that are shared between the television division, or between the regular and the big screen division, and they're just in the television division, so they just work for the division, not for a particular, regular or big screen. Once the company prepares a contribution margin format, it can use that to make decisions and perform break-even analysis. So if we had a 5% increase in sales, then due to 5,000 additional advertising, is that a good thing or a bad thing? Well, we can look and we made $60,000. All right, but now you can do a 5% increase in sales. The margin increases by 5,250. And then here, the margin increased by 2,250. So the margin is going to increase by $7,500. Our advertising is 5,000, so we're 2,500 ahead. So compute company-wide and segment break-even points for a company with traceable. All right, so here is the information again that we're looking at, and we're going to calculate the company-wide break-even point. Okay, and so break-even point is equal to, again, the fixed cost divided by, here it's the contribution margin. All right, and so that's $361,000. Now we're going to compute the break-even for each business section. Same thing, break-even is, we see that the traceable fixed cost is 90,000 for the television, 80,000 for the computer. We've got a 50% margin on the TVs, and we've got a 60% margin on the computers. All right, so overhead divided by 50 is $180,000 is the break even for the television. And for the computer, it's $133,000. Notice the 25,000 of company-wide common fixed expenses are excluded from the break even because that is a common expense that might not disappear or wouldn't necessarily disappear if we got rid of either television or computer. So costs assigned to a segment should include all costs attributable to that segment from the company's entire value chain. So you notice that we've allocated variables, expenses for manufacturing or for sales, because we know, hey, for everything we sell there, it's going to cost us 3% more. So if we have marketing costs that are specifically attributable to the television division, or if we have distribution that, hey, we know that it's going to cost us X amount to get these TVs to these different markets, or that we have customer service because we know that for this TV, we're going to have a bunch of customers calling us and asking us questions. We want to be able to trace those to the specific segment. And if you can't do that, then you're really not going, it shouldn't be allocated to other segments. So costs that can't be traced should not be allocated because that might distort your true profit picture. Some companies allocate costs to segments using arbitrary bases. All right, so in other words, we're going to allocate X% of corporate overhead to you. But that may give you the false, um, give you a false indication. You may decide, well, then this is unprofitable, and we get rid of this division, and yet all of these overhead costs, you are not getting rid of anything else. So you're really killing yourself or shooting yourself in the foot. This practice may make a profitable business segment appear to be unprofitable. Allocating common fixed costs forces managers to be held accountable for costs they can't control. No one likes that. So we're going to look at a bar and we're going to look at a restaurant. And according to this, the segment margin on the bar is 14,000 and on the restaurant 230,000. And so if we allocate these common expenses across these segments, we're probably going to look like we're not profitable. How much of the common fixed expense of 2,000 can be avoided by eliminating the bar? Well, none of it. So suppose square foot is used on the basis for allocating the common fixed expense of 200,000. How much would be allocated for the bar if it's 1,000 feet and the restaurant at 9,000 feet? So 10% of this would be $20,000. And so if we allocate 20,000 to the bar, then we're going to say, well, this bar is going to lose $6,000. Now the question is, if we eliminate the bar, is that the true case? Would our profit really go up to $50,000 if we eliminated this bar? And there are a lot of, okay, could we expand the area of the restaurant so that we have more capacity because our margins are higher at the restaurant than the bar, which I don't think typically is the case. Or do we need the bar to help with the restaurant because we've got to have drinks? Maybe we could shrink this. So if we could shrink this and expand the restaurant, it might be good. But if we can shrink this, but the restaurant, we can't really expand, we're not going to get any more business. And all we're doing is getting rid of $14,000 in margin profit. We still have the space, we still have the utilities, we still have the insurance, etc. So bar probably should not be eliminated because then if we still have this $200,000 of common expenses, then we're going to drop our profit. All right, so this just kind of gives you a caveat into we really need to look at that specific business. We need to make sure that we can trace any traceable fixed cost expenses we will take into account, but any that aren't really overhead that can be eliminated, that should not be factored in.